Welcome back. Let's learn some of the theories of dividend policy. We'll begin with the classical theories, followed by understanding the effects of clientele preference, signaling, and agency costs on dividend policy. Let's get started. Broadly, the classical theories regarding dividend policy can be separated into two camps: that dividend policy does not matter, and that dividend policy matters. Miller and Modigliani, yes, the same guys who came up with the propositions for capital structure, argue that dividend policy is irrelevant, but it has no effect on the price of a firm's stock or its cost of capital. Again, it's based on the assumption of a perfect world with no taxes, no brokerage costs, and infinitely divisible shares. Under such conditions, argue from the perspective of homemade dividends that investors don't care about dividend policy as they can simply make their own dividends. For example, let's say a firm has a fixed dividend payout ratio of 3%. A shareholder who prefers a payout ratio of 1% can simply keep 1% and reinvest the remaining 2% back into the company. Conversely, a shareholder who prefers a 5% payout ratio can simply sell some stock such that the net cash he receives amounts to a 5% payout. When there are no taxes, no brokerage costs, and infinitely divisible shares, the net wealth effect for the investor is the same as the case where he invests in the company with 5% payout, and likewise for the other investor investing in a firm with 1% payout. Now, let's look at the opposing theories that say dividend policy does matter. These do not rely on MM's perfect world assumptions. There are two arguments to this: the bird-in-hand argument and the tax aversion argument. The bird-in-hand argument is based on the expression, a bird in hand is worth two in the bush, where the bird in hand refers to cash dividends already in the shareholder's hands, and the two in the bush refer to expected future returns. The main argument by Gordon and Lintner is that investors place a higher value on $1 of dividends that they are certain to receive than on $1 of expected capital gains. So, due to investor preference for companies that pay high dividend, the implicit argument is that a company that pays dividends will have a lower cost of equity capital than an otherwise similar company that does not pay dividends. The lower cost of equity should result in a higher share price. However, contend that this argument is incorrect because paying or increasing the dividend today does not affect the risk of future cash flows. Such actions only lower the ex-dividend price of the share. The tax argument stems from the historical trend of dividends being taxed at a higher rate than capital gains. Academics argue that investors will prefer to not receive dividends due to their higher tax rates. Taken to the extreme, this theory implies that investors would want companies to have a zero dividend payout ratio, so they'll not be burdened with higher tax rates. In the real world, tax laws often prevent companies from accumulating excess earnings, making dividend payments necessary for some companies. Also note that in 2003, tax laws in the United States changed so that both dividends and long-term capital gains are taxed at the same 15% rate. Before we move on, let's consider the real-world impact of differences in tax rates. We've learned in Level 1 that on the ex-dividend date, the price of a stock should fall by approximately the amount of dividend paid out per share. However, this is only accurate if there's no difference in tax treatment of dividend versus capital gains. If we consider the effect of differences in tax rates, the expected drop in price may be slightly different, given by this formula. This is because the investor would be indifferent between receiving the dividends and this amount in capital gains. As such, the actual drop in price is expected to be lower than the dividend itself. Let's illustrate with an example. In Megaland, capital gains are taxed at 20%, but dividend is taxed at 30%. A company based in Megaland is due to pay out a $10 dividend to its shareholders. The share price closed at $110 right before ex-dividend date. What is the expected price of the stock ex-dividend? Pause the video now and work out your answer. And we're back. You shouldn't have much problem with this. Simply plug in the figures into the formula and we get expected drop in stock price of $8.75. Therefore, the stock price on ex-dividend date is expected to be $101.25. To verify, let's say an investor who bought the stock at $101.25 chooses to sell at $110 right before ex-dividend date, so his capital gain is $8.75. After 20% tax, his net gain is just $7. But if he takes the dividend, he receives $10. But after 30% tax, his net gain is also $7. Therefore, if the expected drop in price is $8.75, he would be indifferent to selling before or after collecting the dividend. So we've gone through three theories, all with opposing views. While argue that dividend policy does not matter, The bird-in-hand argument presents the case that investors prefer dividends, while the tax aversion argument presents the case that investors avoid dividends due to tax disadvantages. Empirically, research does suggest that higher tax on dividends does result in lower dividend payouts. In the United States, however, the change in tax law that put dividends and capital gains on common ground is likely to make the tax aversion theory irrelevant. Besides, there is also empirical support for the bird-in-hand theory, as some companies that pay dividends are perceived as less risky, and specific groups of investors do prefer dividend-paying stocks. Counter this argument by saying that different dividend policies appeal to different clienteles, and that since all types of clients are active in the marketplace, dividend policy has no effect on company value if all clienteles are satisfied. Besides these three classical arguments, there are additional perspectives that kind of further complicate our understanding of the effects of dividend policy. These are the clientele preference effect, which we have briefly touched on, the signaling effect, and the effect of agency costs. Let's go through each of them. Clientele effect refers to the varying dividend preferences of different groups of investors. Individual investor preferences support the clientele theory. For example, some retired investors may have a preference for higher current income and prefer to hold stocks with relatively high dividend payouts. Alternatively, younger workers with a long time horizon might favor owning shares of growth companies for long-term capital gains, and thus prefer stocks that pay little or no dividends. Another supporting rationale is the requirements of institutional investors. For legal or strategic reasons, some institutional investors will invest only in companies that pay a dividend or have a dividend yield above some target threshold. Examples are dividend-focused mutual funds and some trusts that are required to hold dividend-paying stocks. Conversely, other institutional investors would prefer to hold stocks in companies that conserve cash to grow the company. One example is growth-focused mutual funds. The tax bracket that different investors fall in also lends support to the clientele theory. Due to the differential tax rates on dividends and capital gains, high tax bracket investors, like high net worth individuals, tend to prefer low dividend payouts. Conversely, low tax bracket investors, like some corporations and pension funds, may prefer higher dividend payouts. As mentioned earlier, the existence of dividend clienteles does not contradict dividend irrelevance theory by If the demands of all clienteles for various dividend policies are satisfied by sufficient numbers of companies, a company cannot affect its own share value by changing its dividend policy. Changes in the policy would have no impact, as the firm would be simply swapping one type of clientele for another. Another perspective to consider is the signaling effect. It's a known fact that information asymmetry is present in most companies, where the management has more insights and information on the company's growth prospect than the other stakeholders. The dividends declared by the management convey more credible information to the investors as compared to plain statements. This is so because dividends entail actual cash flow and are expected to be sticky, that is, to continue in the future. Management usually refrain from increasing dividends unless they expect to continue to pay out the higher levels in the future. Similarly, the management avoid cutting dividends unless they expect the current level of payouts cannot be sustained in the future. As such, when the management proposes an unexpected change in dividend payout, it's often seen as a strong signal of the company's prospects. An unexpected dividend increase can signal to investors that a company's future business prospects are strong and that managers will share the success with shareholders. Studies have found that companies with a long history of dividend increases are dominant in their industries and have high returns on assets and low debt ratios. Unexpected dividend decreases or omissions are typically negative signals that the business is in trouble and that management does not believe that the current dividend payment can be maintained. In rare instances, however, a dividend decrease or omission could be a positive sign. Management may believe that profitable investment opportunities are available and that shareholders would ultimately receive a greater benefit by having earnings reinvested in the company rather than being paid out as dividends. For companies that have never paid dividends before, the information conveyed by dividend initiation can be quite ambiguous. On one hand, a dividend initiation could mean that a company is optimistic about the future and is sharing its wealth with stockholders, a positive signal. On the other hand, initiating a dividend could mean that a company has a lack of profitable reinvestment opportunities, a negative signal. In essence, the key takeaway for the signaling effect is that dividends give important signals to the market, so management has to take into account this aspect when setting or changing dividend policy. And lastly, let's study the effect of agency costs. We've learned that agency costs reflect the inefficiencies due to conflicts of interest between the various stakeholders of the company. When it's between the managers and shareholders, we've learned in the topic on capital structure that managers are incentivized to take on risks to grow the company, while the shareholders bear most of the risks. One way to reduce such agency costs is to increase the payout of free cash flow as dividends. With less free cash flow to invest in capital projects, management will have to be more picky in selecting projects and will avoid taking unnecessary risks. Conflict of interest can also exist between shareholders and bondholders, creating additional agency costs for the company. When there is risky debt outstanding, shareholders can pay themselves a large dividend, leaving the bondholders with a lower asset base as collateral. This way, there could be a transfer of wealth from bondholders to stockholders. Typically, agency conflict between stockholders and bondholders is resolved via provisions in the bond indenture. These provisions may include restrictions on dividend payment, maintenance of certain balance sheet ratios, and so on. And so, to summarize this whole lesson, we've learnt the various theories of dividend policy which are seemingly in conflict with each other. We've also learnt some of the effects that could influence dividend policy, and these further complicate our understanding. In essence, if our objective is to establish a relationship between dividend policy and company value, these theories don't give us any conclusive relationship, and neither do real-life studies of companies around the world. What you as an analyst should do is to evaluate whether a given company's dividend policy matches its reinvestment opportunities, clientele preferences, and legal and financial environment. And that concludes this rather long lesson on the theories of dividend policy. In our next lesson, we shall learn the factors that affect dividend policy in practice.